mortgage rates just dropped. The Freddie Mac survey came in last Thursday at 6.37% on a 30-year fixed. That is the lowest number we have seen in weeks. And if you are sitting there right now thinking this is the signal, this is the moment. This is when you stop waiting and start buying. I get it. That instinct makes sense. It also might be the most expensive instinct you follow this year. Look, I am not here to tell you that rates going down is bad news. That would be insane. Lower rates mean lower monthly payments. That part is real. But there is a gap, a big one, between rates going down and it being the right time. For you specifically to lock in a 30-year commitment on the single largest purchase of your life. And the stuff that fills that gap, nobody is putting that on the Redfin listing. So here is what we are going to do. I am going to lay out the best case for locking in right now. Full strength, no straw man. The real argument, the one the mortgage broker would make if they were being honest with you. Then, I am going to turn around and lay out the best case for waiting. Same rules, full strength. And at the end, I am not going to tell you which one is right, because the answer depends on about 7 variables that only you know. Fair enough? Good, let's go. The case for locking in starts here. The 30-year fixed is at 6.37%. That is according to Freddie Mac's primary mortgage market survey, released April 9th, 2026. A month ago, it was 6.57. 6 weeks before that, it touched 6.81. The trend over the last quarter has been downward, not dramatically, not fast, but consistently in the right direction. If you go back a year, the same survey had the rate at 6.64. So you are looking at the lowest rate in roughly 12 months. Now, let me put a dollar amount on that. Take a $400,000 home. 20% down, that is a $320,000 loan. At last year's 6.64%, your monthly principal and interest payment lands around $2,054. At today's 6.37, that same loan costs you $1,998. That is $56 a month, not nothing. Over 30 years, that is $20,160 just from the rate difference. You opened Zillow last night, maybe in bed, maybe on the couch. You scrolled past 6 listings you had already seen. You stopped on one you had not. Tapped the heart icon. Then you did the math in your head and closed the app. That is where most people are right now, stuck in the scroll. The lock-in argument says, stop scrolling. The Mortgage Bankers Association is projecting rates in the low 6s for the rest of this year. Fannie Mae's March 2026 forecast has the 30-year trending toward 5.7% by the fourth quarter. So the floor, if you trust the forecasters, is not dramatically lower than where you are today. You might save another 60, maybe 70 basis points by year end. On a $320,000 loan, that is maybe $41 a month. Is that worth 6 more months of renting? And here is the part that does not show up in the rate forecast inventory. Existing home sales in March hit 3.98 million annualized. According to the National Association of Realtors, that is the lowest in 9 months. The lock-in effect is real. More than half of current homeowners are sitting on rates below 4%. Based on Consumer Financial Protection Bureau data from 2024, they are not selling. And the ones who do list, they are listing at $408,800 median. Per NAR's March 2026 report, that number has not come down the way rates have. The Prolock argument boils down to this. Rates are within spitting distance of their likely floor. Prices are not dropping. Inventory is tight. Every month you wait, you are paying rent that builds zero equity, competing against a buyer pool that is watching the same rate charts you are, and betting that the market will hand you a better deal than the one sitting in front of you right now. And that is not a crazy argument. I want to be honest about that. Nobody talks about the cost of waiting tables at the decision buffet. Rent is not free. Every month that goes by is money that evaporates. Now, here is where the other side gets the mic. But here is the thing. The case for waiting is not just about rates going lower. If that were the whole argument, it would be pretty thin. The real case for waiting is about what happens underneath the rate number. The stuff that moves slower but hits harder. Start with the 10-year Treasury. Mortgage rates do not follow the Fed funds rate directly. They track the 10-year. As of this week, the 10-year is sitting around 4.25%. The spread between that and the 30-year mortgage rate is about 2.12%. The historical average spread is roughly 1.7 to 1.8%, according to Housing Wire's analysis of long-run data. That gap, that extra 30 to 40 basis points above normal, is banks pricing in uncertainty. If that spread normalizes, and I am working with publicly available data here, not telling anyone what to do with their own money, but if that spread compresses back toward historical norms, mortgage rates could drop meaningfully without the Fed doing anything at all. I did not expect that number when I ran it the first time. I went back and checked it. The spread data held. Here is a person worth thinking about. Someone in their early 30s, renting in Raleigh, working in project coordination, making about $71,000 a year. They have been saving for 4 years. They have got $42,000 in the bank, credit score 745. They have been eyeing a place listed at 375, at 6.37% with 10% down. Their monthly payment, including principal, interest, taxes, insurance, and PMI lands somewhere around $2,800. That is 47% of their gross monthly income. 47%. The 28% rule says they are almost double the recommended ratio. Even the most generous lending guidelines top out at 43% debt to income. This person did everything right, saved aggressively, kept credit clean, stayed disciplined for years, and the math still does not work at 6.37. Now, this is worth pausing on. I am not talking about someone who is bad with money. I am not talking about someone who needs a lecture. This is someone who did the responsible things for years. And the market's current answer is still wait longer, save more, or buy less house. By any reasonable standard, this is exactly the person homeownership was designed to reach. The market's current answer, wait longer, save more, or buy less house. That is the core of the wait argument. The rate drop sounds good in a headline. 6.37 is better than 6.81. Nobody disputes that. But better is not the same as affordable. And affordable is the thing that actually matters when you are signing a 30-year note. Now let's talk about what happens if you lock in and rates keep falling. The average cost to refinance is somewhere between 2 and 6% of the loan amount, according to Bankrate's 2026 analysis. On a $320,000 mortgage, call it $8,000 on the low end. If rates drop another 75 basis points to 5.62%, you save about $156 a month. Divide 8,000 by 156 and your break-even point is 51 months. That is over 4 years of paying the higher rate before the refinance starts. Actually, saving you money. Start with the home at $320,000 borrowed. You are paying 6.37. Your total interest over 30 years is just north of $399,000. If you had waited 8 months and locked in at 5.9, same loan, same term, your total interest drops to $361,000. The difference is $38,000. That is not a rounding error. That is a car. That is 2 years of daycare. That is a real number. I know someone who closed on a house in Charlotte last October. Good rate for the time, 6.71. 2 months later, rates dropped 20 basis points. They texted me, should I refinance? I said, run the break-even math. They did, came back and said, never mind. Anyway, here is what the wait argument actually rests on. The wait argument says, the macro conditions that pushed rates to 6.37 are not done pushing. Forecasters across the board, MBA, Fannie Mae, Goldman Sachs Research, are projecting rates in the low sixes or high fives by year-end. Goldman Sachs Research, as of their March 2026 update, is calling for 2 Fed rate cuts later this year, in September and December, which would bring the funds rate to around 3 to 3.25%. If those cuts materialize and the Treasury spread normalizes, you could be looking at mortgage rates starting with a 5 by early next year. Somewhere in a kitchen in Raleigh, someone is holding a phone with 23% battery, looking at a mortgage calculator, running the same 2 scenarios for the 4th time this week. The numbers are different every time, not because the math changed, because the assumptions keep shifting. But here is the part that should make you stop and recalculate everything. The weight argument has a cost too, and it is not just rent, it is the price of the house. If home prices appreciate even 2 to 3%, which is what NAR's chief economist is projecting for this year, that $375,000 house becomes somewhere around $382 to $386 by December. The down payment goes up, the loan amount goes up, and some of the rate savings you were waiting for get eaten by a higher purchase price. That is the trade-off nobody puts on a chart for you. Actually, let me show you the math. Take the project coordinator in Raleigh. If they buy now at $375 with 6.37%, 10% down, their total cost over 30 years including principal, interest, taxes, insurance, and PMI is roughly $971,000. If they wait 8 months, rates drop to 5.9. But the price goes up 2% to $382.5, same 10% down. Total cost comes to roughly $943,000. They save about $28,000 by waiting. But subtract the rent they paid for 8 months, call it $12,000. Net savings, $16,000. $16,000 over 30 years, about $44 a month. Classic. That is the whole game. The lock-in crowd is not wrong. The wait crowd is not wrong. They are answering different questions. Locking in answers the question of certainty. You know your payment, you stop renting, you start building equity, you are done deciding. Waiting answers the question of optimization. You might get a better rate, you might save $38,000 over the life of the loan, but you are also betting on a forecast and paying rent while you wait. Every single institution that profits from you buying a home. The lender, the agent, the title company, the inspector, the appraiser, they all get paid when you close. Not one of them makes a dollar when you say not yet. That does not mean their advice is wrong, but it means the incentive structure only points one direction. This is not financial advice. This is the kind of structural observation that changed how I look at every recommendation. I hear from anyone with a closing date on their calendar. Here is what both sides agree on, and this is worth reading twice. The difference between buying now at 6.37 and buying 8 months from now at 5.9 on a $320,000 loan is not hundreds of thousands of dollars. It is about $44 a month, after adjusting for price appreciation and rent. The difference between buying a house you can afford and buying one that stretches you to 47% of your income, that one will follow you for decades. The rate matters less than the ratio. I will say that again, the rate matters less than the ratio. Nobody posts on Instagram about their debt-to-income ratio, but that number runs your life more than the rate ever will. So here is the question I am going to leave you with, and I mean this. Do not answer it for me, answer it for yourself tonight, with a calculator open. Not a mortgage rate calculator, an income calculator. What percentage of your gross monthly income would this payment actually be? Not the payment on the dream house, the payment on the house you are actually looking at. If that number is under 30%, the rate debate is a rounding error. Lock in, wait, refinance later, whatever, you are fine. If that number is above 40, no rate on earth fixes that. Not 6.37, not 5.9, not 4.5. The rate is a number on a screen. The ratio is the thing you live inside.